Hey YouTube, this is the Robinhood Investor. Hope you had a great week of trading. As always, I really appreciate your support, so if you like this video, give it a thumbs up. And if you want to learn about investing, subscribe to this channel. Today I'm going to talk about a stock that reported earnings earlier this week. That's Intel stock, ticker symbol INTC. Make sure you stick to the end of the video for my opinion on this stock. So Intel is currently priced at $50.84 per share. And as you can see, when they reported earnings, they reported some negative news, which is why the stock is down 16.24%. At one point, it was $61, but it drastically dipped 16%. Past year, down 3.18%. Past 5 years, up 71.64%. So overall, it's been trending upwards the past 5 years. Market cap is $214 billion. P/E ratio is 11.12 and dividend yield is 2.14%. So it's great to see the capital appreciation with the stock as well as the dividend yield. Now, in terms of the earnings itself, you can see actual earnings per share was $1.23, which beat the expected earnings per share of $1.10. And Intel, for those who are not familiar, they manufacture computer chips, products and technologies, computer networking, data storage, communication platforms, so a wide variety of technology products. So taking a look at the actual earnings itself, Q2 2020, this is the earnings presentation. So executive summary, high level, they had outstanding results in a challenging environment. Q2 revenue up 20% and earnings per share up 16% year over year. So it's good to see that double-digit growth. Their technology is essential for delivering critical services and enabling people to work, learn, and stay connected. So during these times, Intel is definitely high in demand. Even pre the negative news, before all this lockdown, it was still high in demand. Accelerating 10 nanometer products, launching Tiger Lake in Q3, Ice Lake server wafers in production. Now, negative news is 7 nanometer CPU products shifting 6 months. So they're delaying that specific line of products by 6 months, which gives its competitors an advantage. Since, for example, like AMD, as well as a Taiwan semiconductor manufacturing company, focus on 3 priorities, which is accelerating growth, improving execution, and deploying capital for attractive returns. So they're definitely investing for growth and for long-term return on investment. So it's great to see that high-level positive strategy. And in terms of the priorities, as I mentioned, accelerating growth. These are some of the key reasons they're doing with the growth. So introducing Cooper Lake, 3rd gen Xeon scalable processors optimized for AI, artificial intelligence. Cloud up 47% year over year, and comms up 44% year over year. So great growth drivers in cloud and communications. Mobileye ADAS design win with Ford. They launched the i9, world's fastest gaming processor. Launched Lakefield, leveraging Fovero's 3D packaging technology, and powered on petaflop scale GPU with highest capacity EMIB. Now, in terms of improving the execution, on track to return their normal PC inventory levels, which is good to see because a lot of companies across the board were impacted with the demand, but great to see that they're getting back to normal levels. Tiger Lake delivering breakthrough performance, launching in Q3. Ice Lake server expected end of year. And the Sapphire Rapids second 10 nanometer Xeon SP expected to sample in second half of the year. Alder Lake positioned for second half of 2021, and 7 nanometer CPU products pushed out 6 months to 12-month delay of the process yield. And deploying their capital, they're acquired MoveIt to accelerate Mobileye's mobility as a service offering. Year-to-date cash flow from operations is $17.3 billion, and free cash flow at $10.6 billion, up 88% year over year. Great to see that year over year growth. And paid dividends of $2.8 billion year to date. So it's good to see that they're returning capital to their shareholders just by holding the stock, and they're preserving a very solid balance sheet strength to retain flexibility. So great to see that overall strategy and priorities. And this is overall creating value for corporate responsibility. And some financial highlights include Q2 revenue $19.7 billion. So data centric is 10.2 billion versus PC centric is 9.5 billion. Operating margin 31% flat year over year. So good to see that kind of margins, but was hoping for more growth. At least they maintained the level year over year. Delivered Q2 earnings per share of $1.23, up 16% year over year, which is 13 cents above expectations. And as you can see this graph, year over year, you can see that 16.5 to 19.7 billion, which is up 20%. And data centric up 5 points year over year to 52%. So Q2 results well above expectations on notebook, NAND, 5G, and server. 10 nanometer product acceleration continues. So great demand for their 10 nanometer products. Earnings per share up 16% year over year. And that's driven by strength in server and NAND, partially offset by the 10 nanometer product acceleration. Now, in terms of, 2020 year-to-date sources and uses of cash. So you can see 2020 beginning total cash investments. That's the cash from operations, capital expenditure, dividend yield, buybacks. Great to see them buy back their stock, which means they're confident in their company. 7.5 net debt. This is other, and then 2020 year-to-date total cash investments. Operating cash flow of 17.3 billion, delivered 10.6 billion of free cash flow year-to-date. So you can see revenue in billions of dollars, up 43% year over year. Platform versus adjacencies. And this is data center group. You can see 72% year over year, which is great to see that kind of growth. And operating margin increased as well. So great to see that year over year increase in operating margin. In terms of breakdown, you can see Q2 2019 to Q2 2020 year over year revenue growth. Platform was 36%, adjacency 118%. Cloud, 47% year over year revenue. Enterprise and government, 34%. Comms SP, 44%. So great to see those numbers, very solid year over year growth. Other data centric business segments, revenue up 14%. Client computing group, you can see revenue up 7% year over year. Operating income down 24%. So you can see the platform year over year is 4%. Modem is 30% year over year. Notebook is 14% year over year. And desktop decreased by 14% year over year. Now, in terms of future outlook, Q3 20, that's next quarter, they expect revenue to be down 5% year over year. Operating margin, 30%, so it's down 6 basis points year over year. Earnings per share down 22% year over year. So they're not expecting Q3 next quarter to be any better. It'll dip slightly. Full year 2020 outlook, revenue up 4% year over year. Operating margin down 1 basis point. And earnings per share to stay flat. Taking a look at the actual, the financials. So you can see annually, Intel has been doing pretty well year over year. You can see 2018, 2019, the revenue and earnings are very good. Quarterly, you could see that first quarter took a slight dip relative to the previous, and then the second quarter dipped a little more. For analysts' recommendations, you can see it's a 2.7, so it's leaning towards a hold rating. Analyst price targets, currently it's $50.59 versus the average of $62.72. For key stats, taking a look at the financials, ratios, you can see trailing PE, which is in the past 12 months, 9.29 versus forward price to earnings of 10.41. So it's relatively low relative to tech sector. Now, PEG ratio factors in the PE ratio relative to growth is at 1.38, which is not bad. Anything below 1 is good, but this is slightly above 1. And in terms of 52-week change, it's underperforming the S&P 500 at 3.66% versus the S&P 500 is 6.44%. A lot of institutions hold this stock, so that's 69%. Dividends, it's great to see them increase their dividends, trailing dividend yield of 2.14% versus forward dividend yield of 2.19%. And their payout ratio is 24.76%, which is very good to see. Anything below 50% payout ratio is very good, meaning they're able to sustain the dividend yield that they pay out to investors. For profitability, I think they're very profitable. So profit margin is 29.97%. Operating margin is 33%. So great to see them profitable during these times. Return on assets is 11.63% versus return on equity is 30.15%. So pretty effective management of this business. Their revenue is $78.96 billion. Gross profit of $42.14 billion. Earnings before interest, tax, depreciation, and amortization is $38 billion. Net income is $23 billion. Diluted earnings per share is $5.44. Quarterly earnings growth, 22.2%. Total cash is a big chunk of change at $25.81 billion. So we want to see this large cash position so that they can maintain their business even during these tougher macroeconomic times. Total debt is $38 billion. Total debt to equity. So for every dollar equity they have $46 in debt. Current ratio is 1.98, and operating cash flow is $37.91 billion. Levered free cash flow is $16.77 billion. So overall, Intel has a very solid financials, and I think even though they might have some short-term issues with delivering their 7nm technology, I think they're still gonna deliver within the 6 to 12 months window, and when they do, I think that'll help with their revenue. But in the meantime, their competitors like AMD and Taiwan Semiconductor TSMC will take charge in that specific category of products. But overall, Intel is solid financials. I think great valuation. Even though it dipped slightly, I think it's a good buy, and they also pay a nice dividend yield. I personally don't have any positions in Intel, but I do have exposure through my index funds. So I plan to continue holding those and have exposure through those ETFs. That's all for this video. What are your thoughts on Intel? Comment down below. Remember to use my referral links below, and both of us get $20 for using personal capital or free stock for using Robinhood. If you like this video, give it a thumbs up. And if you want to learn about investing, subscribe to this channel. See you in the next video.